Welcome back everyone to the Audacious Money Witch channel where we talk about investing and trading and a lot of fun things. Jeremy Financial Education doesn't get Roku stock. Why Roku is the future of TV. A lot of people don't get Roku stock, including Financial Education Jeremy. If you don't believe me, listen to this, okay?
Cathie Wood, wow, has she gotten popular over the past few years. I don't think she really needs any introduction for this video. We're talking about the fact that she has over $20 billion in the ARK ETF now. And over 30% of that capital is only in a few stocks. And I want to share with you guys those few stocks in this video here today and kind of my perspective on these stocks. And some people would say, man, that's way too much money to have in only a few stocks. But Cathie Wood kind of invests like me. Like I would do that. Like Roku, look at this. They have over 5% of their entire main fund in Roku stock. Now, I will say, guys, okay, this one, I don't get it. Maybe I'm missing the boat on this one. I don't get it. I don't see why they'd want to have such an aggressive position in this particular stock. To have over 5% of your entire ETF in this stock is I don't get it. I mean, you know, the forward P, the regular P looks crazy. The market cap's almost 50 billion on this. The price to sales ratio looks insane for this stock. I just don't get it when it comes to Roku. I don't get it, okay? I got nothing good to say about that one. Maybe I'm missing it. I don't get it, okay?
2 years ago, Roku was traded at over $300 a share, with a market cap over $40 billion, with a price to sales ratio of over 20. That's what the market price into this stock. As Jeremy said, I just don't get it in the case of Roku. Well, Jeremy, let me explain Roku to you in a way that you could understand. You see, most people think about Roku as their Roku TV they are watching at home. Some of them don't even use Roku TV, as Roku doesn't include premium TV brand like Sony. When people think about TV, it has been around forever. Those black and white TVs that looks like a big box that people have made into a fish tank now, it hardly is considered as cutting-edge technology. That's why Jeremy goes, I just don't get it. How come a TV manufacturing company or a TV hardware seller could be traded more rich of the valuation that his beloved Meta and Tesla, my Tesla shares in 2021? Of course, that's when the interest rate was at zero. And when there is no gravity, aka interest rate, stocks can fly. The higher the growth rate, the higher the rocket launcher boost a stock has to go to the moon. So Roku, in my opinion, is my Tesla of TV. Let me explain why. Did you know that Roku is actually originally created inside Netflix as the Netflix digital media player project? Anthony Wood was a former Netflix VP that left in 2007 to found Roku. A Roku TV are computer hardware that made it look like a TV, but the software and operating system is all cutting-edge technology designed from the Silicon Valley that knows what they are doing, built it from the ground up to power TV. My point here is Roku was founded by people who really understand the present and future of television and streaming, and came out of a company that is still dominating that landscape. So let's talk about that landscape next. The global television market is massive. Linear TV still represents something like 75% of total TV time today, which is TV you have to tune in at a specific time for, or else you'll miss your show, with streaming representing the other 25%, but that trending is moving further away from linear TV each year. Roku believes that all television will eventually be streamed and that every TV will have to run some form of operating system, kind of like how every smartphone does today. In my opinion, this is a no-brainer, long-term trend to bet on. Roku is trying to become the streaming platform that connects the entire TV ecosystem of viewers, content publishers, and advertisers. The Roku operating system is purpose-built for TV and designed to run on less powerful hardware. ARK Invest sees substantial upside for Roku shareholders as streaming media continues to displace legacy TV. Cathie Wood focused on disruptive innovation. She has a $16 billion fund. A valuation model published by Wood and her team posits a bull case price target of $1,493 per share by 2026, implying a 1,540% upside from its current price. Roku is a leading TV streaming platform. It accounted for 53% of all connected TV, CTV devices in North America, while the next three brands, Samsung, Amazon, and Apple, captured just 34% market share combined. The Roku OS was also the best-selling TV operating system in the United States and Mexico in 2023, which points to enduring brand authority. Roku engages viewers more effectively than any other streaming platforms, and that makes the company a critical partner for content publishers and advertisers alike. And Roku monetizes both sides of the streaming ecosystem. Specifically, it monetizes subscription content with transaction fees, and it monetizes ad-supported content by taking a portion of advertising inventory from publishers and providing ad tech services to media buyers. Roku also has its own ad-supported streaming service, the Roku Channel, which offers a combination of licensed content, original content, and live TV. The company monetizes that free service by selling ad inventory, and it has become quite popular. The Roku Channel accounted for 1% of all TV viewing time in September. That's slightly less than Max by Warner Brothers, Discovery at 1.2%, and slightly more than Paramount Plus. An ad-supported side of the ecosystem is expected to grow particularly quickly. Grand View Research believes ad tech spending will increase by 14% annually through 2030. Similarly, Insider Intelligence expects US CTV ad spending to compound at 15% annually through 2027. Even then, CTV ad spending will account for just 44% of total TV ad spending, meaning the market will be far from mature. ARK Invest's valuation model, a valuation model for Roku that explores three price trajectories through 2026. The bear scenario values the stock at $100 per share, implying a 10% upside from its current price. The base scenario values the stock at $605 per share, implying 565% upside. The bull scenario values the stock at $1,493 per share, implying a 1,540% upside. ARK has a simple investment thesis. Roku is the leading streaming platform in the US, Canada, and Mexico. And its platform is posed to become the dominant purpose-built TV operating system connecting consumers, content providers, and advertisers. From that starting point, ARC makes assumptions about engagement and monetization to arrive at three price targets. Bear scenario. ARC assumes total revenue will reach $3.6 billion in 2026, implying annual growth of 2% in the interim. Base scenario, total revenue will reach $14.4 billion in 2026, implying annual growth of 56% in the interim. I believe the truth lies somewhere between the bear and base cases. Roku, indeed, has a strong market presence in streaming media, and that should support above average growth as more ad dollars move from legacy TV to CTV. Ultimately, that gives Roku a good shot at annual sales growth ranging from 15% to 20% growth through the end of the decade. That means the bear scenario seems to be conservative, but the base scenario and the bull scenario seem far too aggressive. Roku stock is worth buying, but we should temper our expectations. The average analyst is less bullish than Cathie Wood where Roku is concerned. The Wall Street consensus calls for the company to grow sales at 16% annually over the next 5 years. That estimate is reasonable given the projected growth in ad tech spending and CTV advertising, though it would represent a declaration from 30% annual sales growth Roku achieved over the last 3 years. Regardless, the Wall Street consensus makes the current valuation of 3.8 times sales seem cheap. And that multiple is certainly a discount to the 3-year average of 9.1 times sales. Patient investors should consider buying a small position in this growth stock today, provided they understand that a 1,540% return by 2026 is very unlikely. A more realistic projection would be 50% to 100% return during that time. Depending on your attitude, Roku could seem like anything from a screaming buy to a risky, overvalued stock right now. The streaming video giant is attempting to build a profitable business using a model that combines hardware sales and TV content and relies on advertising revenue to power earnings. It remains to be seen whether this novel approach will allow Roku to monetize its large and growing audience in the coming years. The stock's volatility in recent quarters reflects Wall Street's doubts around this core question. Share prices have jumped over 50% in the past year, but are down nearly 80% from their 2021 highs.
That's 100 billion streaming hours, which was strong growth for us. Revenue in the quarter is up double digits. So we had a great quarter. We're really well positioned for the future. No, the launch of a new sports streaming service is great for Roku. I mean, we're the number one streaming platform in the United States. We're going to be a big partner. We'll be a big partner, probably their biggest partner for distributing that service. We have a lot of tools to help them do that. We're a leader in the tools to build engagement. Why do we have 80 million active accounts? Well, it's because we have a great product. Viewers love it. We have a very strong brand. Viewers love the delight and simplicity of Roku. They often have multiple devices in a household. And so, you take all that together. And in fact, we also have very strong retail distribution, both inside the U.S. and outside the U.S. And all of that, along with our focus on streaming, our innovation, our scale, our loyalty of customers, our brand. It all gives me a lot of confidence that we're going to continue to grow distribution of our platform. And we added 10 million new active accounts last year, and we're going to add a lot of active accounts this year as well.
It's even more encouraging that Roku is boosting ad sales even as big advertisers pull back their spending in the traditional TV arena. One thing Roku is lacking right now is the profitability. Once Roku has that, the stock price will be insanely higher from here. Just to let you all know, this is not financial advice. Do your own research. It's your money, your responsibility. Ted loves Roku. Oh, you like Roku, eh? Oh, he loves TV. You're a YouTube star, Ted.